Hi, I'm GK Srinivas, partner at the Northstar CPAs. If you have incomes in both India and in the US, one of the concerns that you may have is whether the income is taxable in both India and in the US. This is where the DTAA or the Double Taxation Avoidance Agreement comes in. The purpose of the DTAA is very simple. It ensures that no income is taxed twice between two jurisdictions. Let's take an example. Let us assume that you have a house in the US and you are living in India, or you're a tax resident in India. In this case, the DTAA basically ensures that you do not pay taxes on the income that you earn from the house in the US and also in India. That is where the regulations as per the India-US DTAA kick in. In these cases, generally, one country allows you to claim a foreign tax credit of the taxes you paid in that country in the other country. In this example, the taxes that has been paid in the US is allowed to be claimed as a foreign tax credit in India. Let us look at a simple example. For example, somebody in the US who has a house property there but is a resident in India is required to report income from this house property in both US and in India. However, given that the income is offered to tax in both countries, would not require you to pay taxes in both countries. This is where the Double Taxation Avoidance Agreement kicks in, where the taxes paid in one country can be claimed as a foreign tax credit on the other country. Just because the DTAA exists does not mean that the income can be ignored. However, the income has to be reported in both the US and in the India return as required, and then appropriate credit or exclusion can be claimed. If this is not handled properly, you could end up paying more taxes than what is required to, or end up paying heavy penalties if there is no reporting. If you found this video helpful, please subscribe to our channel to get more informational video on cross-border taxation.